My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people rank friends, I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I know you want to get in, get out. You want to take your profits. You want to go home. You've had it with the stock market all of a sudden. You wish you'd never heard of it. Would have been better to bet on the Masters, the Sixers, the Brooklyn Nets, maybe even the Miami Heat. Not the Knicks. But on a day when the Dow shed 145 points, S&P declined 0.97%, NASDAQ tumbled 2.22%. That's where the pain is. That's what I'm hearing are people who just feel trapped. Well, I'm giving you a talk tomorrow to members of the CNBC Investing Club at 12:30 p.m. about how to take evasive action in this environment. It's not all that bad. But let me give you a preview. This is not the time to sell everything. It's the time to pause your buying of some areas, but not even by all means other areas. Between the war in Ukraine and the Federal Reserve, it's difficult to spin a positive scenario about some stocks like tech, but not others like the consumer stocks, the drug stocks, the insurers, and maybe soon the financial stocks. Remember, as I've been saying for ages, companies that make things and sell them at a profit and return some of that profit to shareholders are going to be fine. That remains the case. Those are still in bull market mode. All right, that's certainly not the point of tomorrow's club meeting, though. Members are far more likely to hear a rendering of our charitable trust moves. And just to be sure, anyone from any firm who tries to claim ownership of my charitable trust is misleading you. I'm positive on the consumer and the consumer product stocks, but it's a tougher road on tech, as I've said at our morning meetings this week. So why be inclined to buy weakness when we get oversold again? All right. First, you need to understand that we are not in a time where there's grave systemic risk to the economy or the country, save the possibility of nuclear war, which sadly is truly on the table with someone like Vladimir Putin, who's demonstrated a shocking level of instability. I never thought I'd long for the good old days of the Brezhnev administration. The fact is, if Ukraine plays for a tie, then the risk of nuclear war is reduced. If it plays for win, there's a higher chance Russia pushes the red button. I want Ukraine to win decisively, but I acknowledge that's the higher risk strategy. These sanctions are so ineffective, and you want to know why? According to EU's foreign policy chief, Joseph Borrell, the member states have made energy payments worth $38 billion to Russia since the invasion. They've given them $38 billion. That's shocking versus the meager sanctions we put on them. Second, even if the Fed raises rates dramatically, something that might feel like a war against your assets, your homes, your second homes, your boats, maybe even your stocks. Remember, most people don't own any of those. Hey, you know, when I was growing up, Pop took me to work with him every Saturday. And I used to get scared when I went past a religious shelter for the less fortunate with a sign that said, "I cried when I had no shoes until I saw a man with no feet." I remember asking Pop what it was like. I mean, do you think to have no feet? He described it, but he also said it was really a reminder of how fortunate we were. Pop had a steady job selling boxes, gift wrap, printed bags to retailers. We had a house. So those with real assets going down in value, hey, you got shoes, plenty of them. Next, even if you want to get out of this market and jump back at a lower level, that's a mistake. Do you really think you can do that with perfect timing? I like analogies. I'm using the 2018 decline, the last time the Fed also declared war on inflation, and even as it was a fraction of what it was around this time. I remember that bottom well. It came after a highly respected money manager came on Scott Wapner's show and said it was all over for equities, and that's when you had to get back in. The timing was tough. It would have been much easier if you simply never sold in the first place. But how about something more recent, the scare of a lifetime at the start of the pandemic? Who knew when to get in on that bear market? Once again, multiple very rich hedge fund managers came on air and talked about the apocalypse. One literally said hell is coming. But that sell call right then, hell is coming, heard around the world, was precisely when you had to buy. That was the end of that bear market. Listen, I've only made a sell everything call once in October of 2008 when I said to take any cash you might need for the next 5 years. It was a remarkably good call. And if you got back in again near the bottom in March of 2009, you dodged a 40% decline. And you know what? I'm still roundly criticized for scaring people away from the market because you would have done just fine if you held on for a few years. I think it was right to sidestep that meltdown, but a lot of people don't like being nimble investors, and they're furious at me. They're still furious at me. So the lesson is to stand pat and even put some of that money to work if you have raised cash like we have for the trust. And we're putting some to work now. Even if you're told to sell and you get the timing right, maybe you shouldn't listen. Of course, each proximate cause of these sell-offs was different. 2018, we had a too aggressive Fed. In 2020, we had a pandemic. This time, we got out of control inflation that's reminiscent of what I experienced when I first started trading. Back then, everyone was running out of the Bernie theater, and I ran in. Maybe it was dumb luck. Fire burned out. But not before I was firmly ensconced in a seat. Made me a lot of money. But the lesson is clear. It's never as bad as you think it is. That said, we have two markets right now. One's an insane bull market that nobody's talking about, and one's a terrifying grizzly that everybody's talking about. When inflation was soaring and the Fed had yet to take action, the consumer packaged goods stocks were getting hammered and tech was running. Now the Fed's trying to kill inflation, so the consumer packaged goods plays and the drug stocks are on fire. So will many companies that have to buy things that just kept going up and up in price. You know what? I think the banks may be next to run, given how low they are. But tech's in the doghouse. Bulls, travel, leisure, oil, consumer packaged goods, pipelines, insurers, agriculture, non-industrial aerospace, bears, tech and banks. But can the latter stay this cheap? Listen to tomorrow's club meeting to find out. One last thought. Many investors don't remember the fabled crash of '87, known as Black Monday or Terrible Tuesday, where the Dow fell from 2,300 to 1,400 in 2 days. Maybe you weren't even born yet. But here's something to keep in mind. If you had bought equal amounts of the top 10 most active stocks the Friday before that crash, arguably the dumbest day in history to buy stocks, you would have been up a year later. What's the ultimate takeaway? If people come on TV and tell you to sell everything or that it's the biggest bear market ever, you better be real careful. The apocalypse is not coming. Even if they scare you out of your wits 9 times out of 10, you should strap yourself to the mast, stay the course, and don't think that hell is here. Let me put it another way. I have a friend who sold everything last week because of fears of a nuclear war. I didn't try to talk him out of it. I have no idea what Putin will do. None. But I did trade through the period around Chernobyl, close call to a nuclear event, as well as Fukushima, another disaster. That was a buying opportunity. So many sold all their stocks on the news of both of those events. If you look back, though, you won't even recognize why you sold them because you can't see them on the chart. The bottom line, no matter how scared you get, most people aren't nimble enough to get out of this market and then get back in again at a good price. That's why it's a mistake to sell everything, even as the market's gotten more difficult for some once favored stocks, even as I could argue that a whole new bull market has come alive with pleasure. AJ in Wisconsin. AJ.
Booyah, Jim. How are you doing?
I am good. How are you?
I'm great. Thank you. With farmer income expected to exceed prior cycle highs, constrained agriculture supply, and all-time used equipment inventories, John Deere is poised for growth. The business has superior fundamentals, is building out their software business. My question for you is, how will ongoing commodity price shifts as a result of conflict in Eastern Europe affect John Deere's next 12-month financial results? And is there a buying opportunity at this level?
All right, this is a terrific question. I happen to like the ag stocks. I like AGCO and I like Deere. And their principal cost is steel. And I think the price of steel is going down. Now, I have to tell you, I think the price of grains are going up, and that's going to be a problem unless the war ends. If the war ends, the ag stocks, these ag stocks are going to be unbelievably good. And I think that could happen. Let's go to Jay in Missouri, please. Jay.
Jimmy,
Yo.
how are we doing?
All right, how are you?
Good, good. Just dealing with some allergies, but you know how spring weather gets.
Yep.
So just wanted to touch base real quick, just get my hometown. I see you kind of give the apes a hard time from time to time, but what's your thoughts on AMC's purchase of HYMC?
Okay, now, I mean, I want to be careful about with the apes because they have now... I'm now the most hated person on Twitter, which is really rather amazing because I don't think I deserve it, but I can take the heat. I love Adam. He's from Philadelphia. Aaron's right down the beach, like 2 miles from me. He's done a remarkable job. I think as long as he's in AMC, I think it's going to be fine. Why am I hated? Look, I don't even know. I told my wife last night, I said, listen, don't read Twitter about me. Just read what I write on Twitter. Ryan in Connecticut. Ryan.
Hey, Jim, how are you?
I am good, Ryan. How about you?
Good, thank you. First, I just want to thank you for all that you do, and I want to also point out that your books are excellent.
Ah, thank you. You're terrific. Thank you very much.
My question is in regards to Target. Their operations and their execution are sound. They have a fair valuation, a fair PEG ratio. My question is, do I have your blessing in starting a position at these current levels, or should I be looking at the other discount retailers?
Well, I mean, I am a big believer that Walmart and Mike Truss has a big position in Walmart and a big position in Costco. And we think those are the ones that are the inflation fighters. But as the Fed lowers inflation, Target becomes more and more attractive. And let's not forget that. Not everything is a falling knife tech stock. And yet everybody seems to think that is all there is in this market. All right, it is a mistake to sell everything, even though I'm the first to admit that this market has gotten more difficult for the tech stocks. On Mad Money tonight, Lowe's, the company behind the hotel chain, lacks some serious coverage on the street. So could this be a benefit to home gamers? I'm taking a close look at the stock. Then the averages are rolling over again. But what is the VIX signaling? I think it's going to be very surprising to you. And last week, the CDC dropped its risk advisory for cruise travel. And I'm learning more about this industry from Frank Del Rio, which I think is going into bull market mode. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.